Welcome back to the deep dive. Okay, so today we're going to sidestep, the usual day-to-day market noise. We're diving into the long-term picture for a major energy infrastructure company, looking at their Q3 2025 earnings call and the stuff they put out with it.
Yeah, and it's a good approach because, well, that's exactly what the company's leadership did. Their executive chairman, Rich Kinder, he basically said right at the start, let's forget the undue concentration on quarter-to-quarter stuff and focus on two huge long-term drivers.
Right. Two really big things shaping their world. And what are those?
Well, they're connected, but, distinct. First, there's a whole natural gas growth story, huge demand. And second is their strategy, basically, how they plan to build all the infrastructure needed for that gas.
Got it. So our mission here is to really unpack those demand drivers, understand just how big they are, and then how a company this size actually plans to, well, capture that growth. So for you listening, what are these two massive engines driving all this need for gas infrastructure right now?
It's sort of a dual thing, really. You've got this big global pull and then a major domestic push.
Okay.
The global pull, that's liquefied natural gas, LNG exports, big demand overseas.
Yeah.
And the domestic push is this almost incredible need for reliable electricity. And that's mostly being driven by AI data centers popping up everywhere.
Okay, let's start with the LNG piece, because that seems like the one where everyone agrees the growth is going to be huge and, soon. The materials we looked at suggest U.S. gas needed just for LNG exports. It's expected to at least double between now, 2024 and 2030.
Yeah, double is kind of the baseline number people are throwing around. But get this, some forecasts are even wilder. S&P's Commodity Insights, they peg that increase at 130%.
Whoa, 130%.
Yeah. I mean, if that actually happens, you're looking at total feed gas demand jumping to maybe 31, 32 billion cubic feet per day. BCFD. By the end of the decade, that's a fundamental shift in the market.
It's almost hard to wrap your head around that number. But the company pointed to some real-world evidence that this isn't just theory, right? They mentioned 6 new LNG projects hit what's called Final Investment Decision, FID, just in 2025.
Exactly. FID is the key step. It means, the money's real, the contracts are signed, they're actually building these things. And those 6 projects alone, once they're up and running, they'll need another 9 BCFD of gas.
9 BCFD just from those 6.
Right. So this isn't some pie-in-the-sky forecast for 10 years out. These are real contracts that need gas, and crucially, they need pipelines to get that gas to the coast.
Okay, so that's the global pull. Crystal clear. Now, let's switch to the domestic side, this AI power crunch. This is where the scale of what's needed gets, well, frankly, a bit surprising when you dig into it.
Yeah, what's really interesting here isn't just that AI needs a lot of power. It's that it needs nonstop power, 24/7, 365.
Yeah.
And that specific requirement, uninterrupted supply, really changes the game for which energy sources can actually scale up fast enough right now.
Right. So you've got basically 3 main options trying to meet this demand spike: renewables, nuclear, and natural gas. And if you walk through the pros and cons they laid out, it becomes pretty clear why gas is sort of winning the immediate race.
Well, let's take renewables first. Solar, wind, maybe paired with big battery systems. It sounds great, right?
Right.
Clean operation. But the batteries, well, they're still pretty expensive, and they only cover you for so long, a few hours maybe. But the real kicker, the thing people often miss, is just the physical space they need.
Yeah, this was a fascinating point the chairman made. He actually quoted a New York Times estimate, just to give you a sense of the scale. To get just 1 gigawatt of continuous power from a solar farm, which isn't even that huge, for a major data center complex, you need something like 12.5 million solar panels.
12.5 million panels. And that covers, what was it?
About 5,000 football fields?
Yeah, 5,000 football fields. I mean, just think about trying to find and connect that much land near where you need the power. It's a huge challenge. And wind turbines, they noted, need even more space between them.
Okay, so the sheer land requirement makes massive concentrated solar and wind difficult for quick deployment, especially for these power-hungry AI hubs. So what about nuclear? It solves the space problem, right? Lots of power, small footprint. What's the holdup there?
Time and money. Lots of money. I mean, the U.S. nuclear industry hasn't really built much in, 40-plus years. New plants are incredibly expensive. And crucially for this AI surge, they take 7 to 10 years to permit, build, and get online.
7 to 10 years.
Yeah. That's just way too slow if you're a tech company needing massive power now or, next year.
Which naturally brings us back to natural gas.
Exactly. It's here. It's abundant. It's reasonably priced, especially compared to building new nuclear from scratch. And the key thing, the power plants that use gas and the pipelines to feed them, They're relatively quick to build, much quicker than that 7 to 10-year nuclear timeline.
Got it. So that combination, the guaranteed global demand from LNG plus this urgent domestic need for AI power, creates this huge, reliable, long-term market for moving natural gas around.
Precisely. It's become sort of foundational, both for, global energy needs and for powering this next wave of technology right here at home.
Makes total sense. Okay, let's shift gears then. We've established the why the massive demand. Now, how does this company actually plug into that? What's their strategy for turning these huge demand signals into, actual business?
Well, their core strategy really boils down to using their existing size and scale.
Mm-hmm.
Management basically called their current network a prolific generator of cash.
Mm-hmm.
They've got this huge installed base, the biggest in the business, right? And they use the cash that throws off to fund the new pipeline projects. So they're not relying so much on selling new stock all the time. They fund it internally.
Right, which lets them do two things at once. Build these massive new projects, we're talking billions, while still paying a dividend to shareholders. They just approved their Q3 dividend, dollars and more, $9.25 a share. That's $1.17 for the whole year. It's up 2% from last year, modest but steady growth.
Yeah, and that internal funding ability is absolutely critical because the amount of growth they're chasing is it's staggering. Their current backlog, projects they've already committed to build, is $9.3 billion.
$9.3 billion.
And get this, 90% of that is for natural gas pipelines.
Wow. But even that huge number, $9.3 billion, management seemed to suggest the potential beyond that is maybe even bigger.
That's right. They said they're actively pursuing over $10 billion more in potential projects, stuff that isn't signed yet, but they're working on it. And they made this interesting comparison. This $10 billion opportunity set, it's about the same size as their entire backlog was just a few years ago, back when it was only $3 billion.
So the pipeline of potential work has exploded.
Exactly. It feels like the demand is almost outrunning their ability to sign deals and commit the capital. They're racing to lock these huge projects down. And the projects in that $9.3 billion backlog, they are genuinely massive. We don't need to go through every single detail, but the scale is important.
Yeah, let's maybe focus on what they do. These aren't just random pipes, right? They connect major supply areas to major demand centers.
Precisely. You've got the Trident Interstate Pipeline that's almost $2 billion, moving 2 BCFD, expected online, Q1 2027. Then there's Mississippi Crossing, MSX, $1.7 billion, moving another 2.1 BCFD, specifically aimed at feeding the growing Southeast markets. That's late 2028.
And the biggest one, that South System Expansion, SSE4, that's a $3.5 billion total project. Their share is $1.8 billion, adding another 1.3 BCFD, also starting late 2028. But hang on, this raises a question for you, the listener. If AI needs power now, how is a pipeline coming online in 2027 or 2028 really quick?
Yeah, that's the tension, isn't it? It's quick compared to nuclear, definitely. But it's maybe slow compared to how fast tech moves. The reason this company is still positioned so well is because of their existing network, and crucially, the contracts. They are building these huge pipes hoping someone will use them. These projects are backed by long-term, often take-or-pay contracts locked in, usually with LNG exporters or big power companies.
And that security comes from their enormous footprint already in place. What is it, 66,000 miles of gas pipelines?
66,000 miles. It gives them just incredible reach. They handle, as you mentioned earlier, over 40% of all the natural gas used in the U.S. Think about that. More than 40% heading to LNG facilities, about a quarter of the gas going to U.S. power plants. If you need to move gas in America, odds are pretty high you're touching their system somewhere.
And you can see that dominance showing up in their current numbers, too. Their gas gathering volumes pulling gas from the wells were up 9% year over year in Q3, driven by places like the Haynesville Shale, Eagle Ford. Haynesville itself was up 15% just quarter over quarter, hitting daily records in October. The demand is literally pulling more gas out.
And, we should probably give a quick nod to their other businesses, too. It shows they're adapting. Like their refined products segment. They're launching this new pipeline, the Western Gateway Pipeline. It's a JV, 50/50 with Phillips 66. And it's specifically designed because California's refining capacity is shrinking. So this pipe will move gasoline, diesel, jet fuel directly from Texas to markets like Arizona, Vegas, maybe even Southern California. They're using their pipeline know-how to solve these regional bottlenecks.
Okay, good point. Let's quickly touch on the money side then.
Yeah.
How did Q3 actually look financially supporting all this investment?
Pretty solid, actually. Adjusted earnings per share, EPS, came in at 29 cents. That's up 16% from the same quarter last year.
16%? Nice.
Yeah. And adjusted EBITDA, that's a key measure of cash flow, was strong too. Almost hit $2 billion. $1,991 million, up 6% year over year.
And looking ahead for the full year.
They expect to beat their original budget. They budgeted for about 4% EBITDA growth and 10% EPS growth for the year. They think they'll do better than that. Mostly thanks to an acquisition they did earlier in the year, the Outrigger deal. Although they did mention a couple of small things that kind of held back the outperformance a little bit.
Yeah, this is where we get the jargon. They mention lower RNG volumes and D3 RIN prices. What are those, and why didn't they tank the results?
Right, so RNG is renewable natural gas. Think methane captured from landfills or farms. And D3 RINs are basically the government credits you get for producing that kind of biofuel. So bottom line, they produced a bit less of this renewable gas than they planned, and the market price for those credits was lower than they expected. It's a relatively small part of their overall business, though, so it was just a minor headwind. Didn't really dent the strong performance from the main natural gas pipelines.
Got it. Small potatoes in the grand scheme. Okay, what about the balance sheet? All this building costs money. How are they managing debt?
Actually improving it. Their key metric, net debt-to-adjusted EBITDA, came down to 3.9 times. It was 4.1x earlier in the year. So they're deleveraging even while planning massive spending.
And the credit markets noticed.
Yep. Fitch bumped up their main debt rating to BBB+ back in August. That lower leverage and strong cash flow gives the bond market confidence, which is critical when you need to borrow billions.
Makes sense. And finally, there were some mentions of tax changes helping out down the road.
Yeah, potential tailwinds starting around 2026, 2027, specifically from tax reform, letting companies deduct the cost of big investments faster. It's called full expensing. For a company like this, spending billions on new pipelines, being able to write off those costs sooner means, well, it means more cash flow stays in their pocket sooner, which gives them even more internal capital to fund the next wave of projects, right, as things like Trident and MSX are really ramping up construction.
Okay, so let's wrap this up. What's the big picture message here? The final takeaway from this deep dive?
I think the core thesis is pretty clear. Their whole long-term game is about taking these two huge, really reliable demand drivers, LNG exports, and that 247 AI power need, and turning them into solid long-term pipeline contracts. And they seem to have the existing scale, the market position, and crucially, the financial capacity to actually go out and win those contracts.
Right, and that financial capacity point you made earlier feels really key. You mentioned the $9.3 billion backlog, the $10 billion opportunity set. Sounds like they're maxed out, but they said they're not.
Not even close, apparently. Management was really emphasizing their flexibility. They put a number on it for investors, remember. Every tenth of a turn improvement in their debt ratio, that 0.1x, that frees up $800 million in borrowing capacity.
Wow, okay.
And given where their debt ratio is now versus their target range, they basically hinted they have at least, $3 billion, maybe more, of debt capacity right now before they even get close to the top end of where they're comfortable being.
So $3 billion of dry powder ready to go, on top of the cash they generate internally.
Exactly.
Yeah.
That capacity means they can jump on new opportunities quickly, maybe sign deals for the next big data center power supply faster than competitors who might be more stretched financially.
So connecting it all back, this company looks uniquely set up to handle the sheer velocity and dollar figures involved in today's energy market.
Yeah, it really seems that way.
Okay, so that leaves you, our listener, with maybe a final thought to chew on. Just consider the incredible amount of money, the sheer scale of investment that the U.S. energy system needs right now. It's not just about keeping the lights on anymore. It's about mobilizing billions quickly to build the basic plumbing needed for global energy security and to power these sudden, massive leaps in technology like AI. The build-out cycle is definitely here. And maybe the defining factor for who wins is simply who has the financial muscle to build it fastest.
Well said. Infrastructure, trying to keep pace with innovation. It's quite a race.
Indeed it is. All right, that wraps up this deep dive. Thanks for joining us, and we'll catch you next time.